Hello everybody, welcome back to part 2 of the video on determining tax implications in bonds in Canada. We've already gone over 2 different examples. We went over what accrued interest was. We know we have to calculate that. That's a very important aspect in determining how much tax or tax implications that you may have on the bond, whether interest or capital gains. In the first example, in the second example, we went over if we purchase a bond at a discount, right? So remember, discount is purchasing a bond less than its face value, and we hold this to maturity, what the impact that will have in terms of capital gains we may incur if we do hold that bond to maturity. In the third example here, we're going to do if we purchase a bond now at a premium. Okay, so remember, we purchase a bond at a premium. This is simply purchasing a bond over the stated face value of the bond, and if we hold this to maturity, what sort of implications, tax implications we have. And it's going to be obviously probably on, well, not obviously, obviously a capital loss situation. So this example is similar to the first 2 examples that we saw. We have $100,000 face value of the bond, 6% interest, originally issued on January 1st, 2017, due on December 31st, 2017, 2 semi-annual coupon payments, so one on June 30th, one on December 31st. Your purchase date or the settlement date when you purchased this was on January 30th, 2017, and the purchase price is going to be now over the par value, the face value of the bond is $100,000, so you're going to purchase this for about a $2,000 premium. Now again, we have to first calculate what our ACB is, just like in the previous example we did. The ACB, if we're going to calculate this, would be the purchase price of this bond. So this purchase price is going to be $102,000. Okay, and then we're going to take we're going to take off the accrued interest that we paid, right? Because remember, we didn't buy this bond on the actual issue date. We bought this at some point in time after. So minus accrued interest. Okay, and that accrued interest we calculated in the previous example is $493.15. This is going to give us an ACB here of $101,000, just over $101,000. So this is our ACB. So 101,506.85 is our ACB amount that we're going to be using. Now the second step that we have to go over is, again, what is going to be the interest income to report during the year. So interest income to report during the year. And obviously, just like in the previous example, we had a June 30th payment, and that was $3,000. We had a December 31st payment, and that was another $3,000. And we're going to less this accrued interest that we paid. Okay, and that was $493.15. So we take that off. These are brackets, right? So we're just taking this guy off. And so that's going to give us interest to report, just like in the previous example, of just over $5,500. Okay, so 5,506.85. Okay, so that's what we would report on interest income if we did hold this bond to maturity. Now the capital loss here, so we go up here and we're going to do the capital loss to report. Okay, so this would simply equal the face value of the bond. Okay, we already know that this is $100,000 less the ACB. So the ACB here, we've already calculated it, is 101,506.85. So if we take that, that's going to give us a loss of just over $1,500.85. So this would be our loss here. Okay, so we'd have just over a $1,500 loss, and we know that we could carry this back potentially 3 years, carry this forward indefinitely to offset other capital gains. And so that's an example of purchasing a bond at a premium. We hold this all the way to maturity, and if we do that, we would have some sort of capital loss to report. Now let's go to the last example that we're going to cover today. And the last example is going to really go over selling a bond before maturity. Okay, so the last example here, if we scroll down to this last slide, so here we have an example of selling a bond for a gain before maturity. So if we're going to sell a bond for a gain for maturity, something potentially may have happened here. So in our case, this is going to be similar to the example that we looked at of buying a bond at a premium. Look, we bought this bond here. This is the same type of example before. We bought this bond at $102,000 on January 30th, 2017. The par value is what? $100,000. So we already bought this bond for a premium. Now here, the selling price, we're not going to hold this all the way to maturity. We're not going to hold this to December 31st, 2017. We're going to sell this early. We're going to sell this in September, on September 30th. Now, in order for this bond to go up and sell for $105,000, something must have happened. And if we go back about bonds and the pricing of bonds, for you guys that are familiar with bonds, we should know that what? Interest rates in the market or in the general market, or for a comparable, must have gone down. Interest rates may have fallen, and if that's the case, the bond price would have gone up. Okay, so this is the case here, or an example we have, the bond price has gone up to $105,000. We're going to say, let's sell this bond, let's get out of this bond. Maybe you predicted the interest rates are going to shift back up in the future, and you're going to sell and get out of this bond at this point in time. So let's go over what we need to do here. Again, we need to calculate, just like in our previous examples, we're going to start with the ACB. Okay, so on the ACB here, we're going to take our purchase price. Okay, and our purchase price here is going to be $102,000. Okay, from here, we're going to now take off, again, just like in the previous examples, we're going to take off accrued interest. And in our previous examples, we already calculated this, $493.15. Okay, so now easy, our ACB is going to be 101,506.85, just like in our previous examples that we've done before with this original purchase price. Now let's see it again. Here again, interest rates have fallen, let's say, so interest rates fall. The selling price now on September 30th is going to be 105. Okay, so we're going to be making some money here. Now, the next question here is, as we've done in our previous examples, the interest to report during the year. Okay, because I'm going to have a couple examples here, because not only did I not hold this bond for the entire duration of the 6 months for the first coupon payment, now I'm only going to hold it for a portion of December 31st. Okay, so I was holding this bond on June 30th. So on June 30th, when this paid a coupon, I got paid this coupon, right? So I took in the $3,000 coupon payment, right? Half of the 6% interest rate for the year. But I'm also going to have to add in accrued interest that is due to me for the period from June 30th, right? So from the period of June 30th, from the period of June 30th all the way to September 30th, I'm also, that money is mine, owed to me, right? I was holding this during that period of time. I should hold this money. So I'm going to also then in the next line plus accrued interest that is due to me from the buyer who's buying this on September 30th. So I'm going to plus accrued interest that's due to me at the sale, and this is going to equal 91 divided by 365. So the 91 is going to come from the time period between June 30th and September 30th. So there's 91 days in total with that. I'm going to multiply this by 0.06. Okay, so the interest rate, and then times by the face value of 100,000, just like we did in the first example of calculating accrued interest. This is going to equal just about $1,500, $1,495.89. So that's money that was due to me. Now let's just scroll up here from here. Let's go up here now. And so here, I've already calculated in previous examples, or I have it here also, less the accrued interest that I had to pay when I purchased the bond. So now what's the interest I'm going to have to report? The interest I'm going to have to report is going to be this $3,000. Okay, so we're going to take this $3,000 from here. Okay, then we're going to add in this $1,495.89, right, from down here. That's money due to me. That's positive to me. And then we're going to subtract this $493 that I originally had to pay to the original seller of this bond. So if I do that, if I make this calculation, the interest that I would have to report on my tax return would be approximately $4,000, right? So this would be interest to report for the year relative to this bond here, just over $4,000. Now, next we're going to do the capital gain to report. So I've just cleaned the page up a little bit. The last thing that we need to clean up here is the capital gain to report. So the capital gain to report on this example here, on the final example. So first we have to calculate the net amount of the POD, right, or the proceeds of disposition. So this is going to equal here, this is going to equal 105,000, right? So 105,000 is the selling price, right? I'm going to receive that minus the 1495.89. Okay, so this accrued interest that was paid to me. So that's going to equal, so the net amount of POD, that's going to equal approximately $103,500. So $103,504.11. So this is the first number we need, is that's going to be the net amount of POD. So this is going to be the selling price, okay, the selling price minus, okay, this guy here. So this is minus the actual accrued interest that was due to me in between these two periods of time here. So if we have that, we've already calculated the ACB. So then we would take the less, we would take less the ACB. And from our previous calculation, we know that's going to be 101,506.85. Okay, so we minus that, and that's going to give us a capital gain in this example of $1,997.26. So this was an example of, selling a bond here for a gain before maturity. We had to do two accrued interest calculations, right? One for the period of time between here and this for between January 1st, 2017 and and this guy here. So January 30th, right? That was the first one. So this 30-day accrued interest, we did that in the first example that we did in part 1 of this video. Then we had to make a second accrued interest calculation from June 30th to September 30th. Okay, and that was accrued interest due to me as a seller. We have to do those two. In order to do that, we're going to then calculate ACB. Then we're going to calculate the interest to report during the year for myself, the owner of the bond, and then we're going to calculate the capital gain. And we could just flip this back, and if we went to the capital loss, we'd go through the same steps. So that's the second part of this example. I hope some of these examples help you understand the impacts of interest, capital gains on bonds in Canada. If you do have any questions, you can leave them in the below comment box, and I thank you for watching.